Let's look at the rubric, the review real quickly what we did last time, because I want to make sure you're ready after this class that you can get this paper going. You only have a couple more weeks to write it, so it's going to come pretty quick here. We talked about the definition of float, and I told you his definition is not adequate, so you have to broaden it out. That's one topic you could certainly do some searches on. You just got to be careful of the word float. We're talking specifically related to really property and casualty insurance. I started my career in life insurance. They don't really use the word float in life insurance. So it really is a property and casualty issue. So what is it? The cost of float, he doesn't want to really mention the combined ratio, but you do want to talk in terms of the combined ratio like we did in class last time, that outflow over the inflow. And then you notice I've got 6 things here. His list only had 3, so I somewhat doubled his list. But he said expected profit. Remember on that, you want to be real clear. He doesn't mean expected profit every single year. It's not possible. But over the life of a policy, you should expect a profit, even though you may have some years where you have losses. So you shouldn't have those massive losses. If you can't price your product to do that, what do? He used the word blithely, didn't he? You happily walk away from business, which seems unlikely, but you let the competition have the business. The ability to evaluate, make sure on the ability to evaluate that you talk about frequency and severity. Those are really, really critical terms there. And then he talks quite a bit about remote loss possibilities that might aggregate. So there's the concept of correlation. Remember, he was shocked. He had property damage and he had workers' comp. The 2 of those coming together. So he says, well, we're covered. We only, we're covering 50 different employers. And say, oh, wait, they're all in the same building. Wow, there could be an event that could hit all of them at the same time. You think that'd be an obvious thing he would know if he's insuring a bunch of workers' comp all in the same building, that could be an issue, but they just didn't think of that. That was that aggregation. The businesses are related, so you think, well, why would all the employees get injured at the same time? But if they're all related by being in the same location, that can certainly do that. I'm going to come back to, I want to spend some time today on experience and exposure. And then you're going to go to that page 10 where he uses these terms about how fast this guy is at getting new business, these massive policies, and just the simple fact that he lists them all in the annual report suddenly correlates them because they're now all related when they weren't before. What is your assessment of that? And then really important down here is other related research. So what could that be? So I don't know what you could search on, but you might just try insurance float and Buffett. Here's something that came out just in 2022. Does that article say something new and different that we haven't covered in what we just talked about so far? This one comes back from, several years ago. Here's a Yahoo Finance article from 2021. That one looks interesting. Here's actually, you can use YouTube. That's not your source could be anything. So you could look at a YouTube video that might be interesting. That's back from 1996. So that's even prior to what we're reading here. That would be interesting, right? You wish you could be in on that live and tell him what mistakes he's about to make. So there's one. Another one we talked about was the insurance underwriting cycle. Talk some of that, because remember, the combined ratio ignores investment earnings. So you can lose more money in insurance if you can make more on the investment side. And so that underwriting cycle is in there. Investopedia has a page on it. What is the underwriting cycle? But it's definitely tied to interest rates and earnings. I don't know what these things on here are. The 4 C's of underwriting: capacity, capital, collateral, and credit. Those aren't the 4. Those aren't the 6 things Warren Buffett talked about. So that's interesting. You could 2001. I don't know how to do it, so it comes up September 9, 2000. September 11th, 2001, insurance losses. You could probably add something on how much insurers lost in that event, which events was. So something related that you can find that adds a little bit more analysis, a little more insight is what I'm looking for. So that would be interesting. Was it workers' comp? Was it property damage? What kind of damage, what kind of losses were these firms having? Find something to add into your paper. Sure. It is a big chunk of the paper.
That could work too, right? Oklahoma City bombing.
You could look at another one from an insurance, make sure it's from an insurance standpoint. Yeah, if you just want to talk terrorism risk overall. And so he said, you know, because he makes a pretty, I think, a really, really bold statement when he says what we do know. And I'm not sure we know all those. So here, so he's talking about terrorism here. And he says, this is what we know about terrorism. The probability, he's talking about just incredibly massive workers' comp type of claim. So a lot of people die all at once. Probability of such mind-boggling disasters, though very low, is not zero. That's probably true of a lot of things, right? That's probably true of our sun blowing up and it's probably not zero. It's hopefully it's 0.000000 with a lot of zeros. This claim, can he say this? The probabilities are increasing. He wrote this in 2001. I would say the probabilities were probably decreasing because of what our federal government was doing. It's some pretty amazing things that people kind of question afterwards. In an irregular and measurable manner, as knowledge and materials become available to those who wish us ill, fear may recede with time. I do agree with this. We get complacent, but the danger won't. The war against terrorism can never be won. The best the nation can achieve is a long succession of stalemates. Until now, insurers and reinsurers have gladly assumed the financial consequences from these. That's true. You know, I saw those 4 C's. One of them was capacity. Here's going to talk about capacity. How large of an event can this industry actually handle before it just topples and goes under? I think people are far more worried about this industry with earthquakes and hurricanes than they are with terrorism risk. But, you know, is there an event that would be so large that the only way to get over it is for the U.S. government to bail out? So you could, Kenny, you certainly could say, you know, what do we know from previous terrorism events? You had the one in France, right? Oklahoma. It's hard to think of terrorism events that were large events for this insurance industry. I don't know about France. France was many lives, right? Can't remember the detail. And we've had a few events here in the U.S., but most of them were lives and not property. And so
I guess like it's something like that. I mean, a shooting, school shooting, property damage, you know, stuff like that.
Yeah, school shootings, because this industry is not life insurance.
Right.
So, you know, as horrific as these things are, if they do workers' comp. So students, as horrible as it is, they're not covered by workers' comp. So there's,
right.
So those type of events, that's why I think like in France probably didn't affect this industry hardly at all. And on life insurance, I remember talking to our life insurance actuaries, they did see claims from 9/11, but those type of events don't destroy life insurance companies. They do destroy. It's really hard to have that many people, you know, all in one place that you can really take that many lives all at once. But workers' comp you can, because you're covering all of those people. So a life insurance company, if 3,000 people die, they may insure 7 of them. Workers' comp, 200 people die and they're under your policy. All of them are in your policy, so it's much more concentrated. But you can certainly do that. Oklahoma City was probably a large insurance loss as well, and probably some workers' comp as well. I don't remember reading anything about the insurance industry there. I know it's somewhat horrific. You're talking about something that's really horrible, but you're focusing on the insurance side. It seems almost callous. But this industry has to function and has to pay its claims, and so they have to make sure as tragic as these things are, that they can actually pay their claims when the time comes. It can be really horrible, wouldn't you have an event like that and they can't even pay their claims because it's such a horrific event. So if you're not sure, if there's something you want to research, you're not sure, I would count it as a 10, email me and I say, yeah, that might work, or take this angle, or something along those lines. Okay, so find something to add to it. So let's go to this last thing here. Experience versus exposure and examples. It's 20% of the coverage parts, so it's 8% of the paper. So let's go back to what he says. Too many of them. He uses the word experience too much too. Okay. In pricing property coverages, so property coverages, that's buildings, cars. We had looked to the past and taken into account only costs we might expect to incur from windstorms, fire, explosion, earthquake. So there's no terrorism in that, but he's using experience. Why? Because there had never been a major terrorism event other than maybe Oklahoma City before that. But what will be the largest insured property loss in history, 9/11, did not come from any of those sources. In short, all of us in the industry made a fundamental underwriting mistake of focusing on experience rather than exposure. So there it is right there. He says it's a fundamental underwriting mistake, assuming huge terrorism risk for which we received no premium. They essentially weren't pricing at all. It's not quite Northridge, where they were pricing earthquake insurance, but just not nearly enough. And that one event wiped out, decades of premiums. All right, let's see if he defines these. Experience is highly useful starting point. It's important for insurers writing California earthquake policies to know how many quakes in the state during the past century have Richter scale 6 or greater. So what is experience? It's actually events that they can look at. Now you notice here, he didn't say the history of insured losses. He said the number of earthquakes, because there's a lot more people living in these areas. So he's not looking at the past actual losses. In Florida, who was living in Florida before air conditioning? Some pretty tough people, right? That's a horror. I don't know if y'all been to Florida, but I hate humidity. But it's a horrible place. If you have air conditioning, you can kind of survive it. But what happens once we get air conditioning? It's a beautiful place. It's warm. A lot of people living there. So you can't just say, well, let's look at insured losses for hurricanes the last 100 years, because there weren't many people there for the first part of that. So they're looking, so this is good from experience. How many earthquakes did we actually have? Not just the losses, since there's a lot more people, a lot more buildings. This information will not tell you the exact probability of the next year. So this is exposure. It's exposure is what you actually can lose going forward, which might be related to history, but it might have some detours that would surprise you. But the statistic has utility, particularly if you're writing a huge statewide policy. So experience does help. Some policies, experience is maybe all you need. Auto insurance is very, very predictable. Auto insurance can be a little tough when speed limits change. New features in a car might change. When SUVs came out, insurance companies were first thinking, well, this is great because we got these massive cars. And so when they get hit, they won't have much damage. And then they start discovering, oh, but when they hit somebody else, they cause a lot of damage. So their property damage went down, but their liability damage went way up.
So in this case, then experience is just giving them an idea of if there was liability loss, it gives them an idea of how much is going to happen, how much
Well-
they lose.
Well, on this one, they may not actually have actual losses. They just know the earthquakes. So let's say there's an area that had an earthquake that was 7. And back then there was 1,000 people living there. Now there's 400,000. They're going to take that 7 and apply it against the 400,000. And because they do have models that do that quite well. It's pretty amazing. We'll probably talk about some of them as we get in here. So they may not just look at actual losses historically. They're going to look at, what could have happened. So they're a little more sophisticated in just looking at losses, but there's the fact that they've had 10 of these events in the last 100 years I mean, that's the same probability going forward. So as we're asking, so, does global warming affect earthquakes? Who knows? Maybe there's not as much rain, the ground's drier. I don't know. There's certainly more mudslides, more forest fires. Does global warming affect hurricanes? We'll look at some of that history. And that's one of the things we're going to talk about is it possible this information is changing for some good reason why you would expect the future to be different than the past. So he gives an example. So before we do an example, I want to make sure everybody's real clear. Sorry, I keep going to the wrong sheet. Real clear, because it's not in the rubric and he doesn't explicitly say it. So it's very important. There's two ways experience can mess you up. All right, let's just make it really clear because I want you all to get this. And think back to your stats class. In statistics, we like to use history to predict the future. So the first thing relates, I think, to terrorism risk. And there's very limited historical experience. So Kenny, you mentioned Oklahoma City, and then you have the towers were bombed, but you're talking events that pretty rare. They weren't massive events like 9/11. So how do you do that? When something happens every decade, every 4 decades, pretty rare events, there's very little information. You could almost say that with the earthquake, true massive 8. We've had, I forget the record earthquake, it was 9 something. 9.5, that's a pretty good sized earthquake. That's going to cause a tsunami, some major damage. Y'all know if earthquake happened and caused a tsunami, how much coverage you have? So your homeowner's policy doesn't cover flood. So if the earthquake doesn't damage your house, but the tsunami does, you're out of luck. We'll talk about that later. But 9.5, that's a massive earthquake. But those don't happen very often. So very limited experience. So terrorism risk, earthquake risk. The second one is distribution is changing. That's where we talk about global warming, hurricanes. So you look at the history, and that tells you something. There may be plenty of history. You got plenty of history of hurricanes. But if the water is warmer, the water is higher, then the hurricanes going into the future may be greater or lesser. There's a lot of debates on exactly what the impact might be. So those are the two things. When you don't have much history and you're trying to predict the future, so do you ensure that at all? That's what you don't have frequency or severity really to look at. Or you have plenty of history, but there's something going on that may be changing that history, and so now you're a little bit uncertain. So he doesn't say those two things, but he implies. So let's look at his first example. And he uses directors and officers. So with the directors and officers, it's the second thing. There's something happening, whereas the history is not reliable because something's actually changing the future. Your future is going to be different. So what is D&O insurance? Well, I noticed it when I worked in boards. The board members are sitting there bored to tears. They got this stack of paper. And then the D&O person walks in and suddenly they're interested. So what is directors and officers? That's the insurance that covers them if they make a bad decision and they get sued. So suddenly they're like, wait, how much coverage do we have? What does it cover? It's like you were sound asleep like 10 minutes ago. What are you doing? That's D&O, directors and officers. I had that coverage for me with USA's 401k plan and pension plan. If I'd messed up, there's 40,000 employees that could sue me. So I'm glad I had that insurance. I think it was like $25 million. And I'm thinking, This is $7 billion in assets and I got 25 million in coverage. That doesn't sound like enough. Can you kind of give me like $7 billion in coverage? All right. So what he's saying here is this liability changes in ways that the history actually distorts the future. So late in a bull market, everybody's making money. Everybody's really, really happy. You're not suing companies, directors and officers because everybody's making money. When are people upset with directors and officers? In a bear market, when markets crash. But right here, late in the bull market, what's been your D&O experience? It's been extremely low because everybody's doing well. Companies, the economy is strong. Even bad managers are doing well just because the economy is strong. Everybody's doing well. When are you most exposed to D&O insurance? Right there when the experience is its best. So that's that flip. You have history, but that history is actually distorting going into the future. That's kind of what I like Taylor. You've read Black Swan. He gives the turkey example. Have y'all heard the turkey example? So this turkey's using experience. So in January, he's like, wow, this is a pretty good life. February, wow, this is a really good life. They just feed me all day. Just walk around and they feed me. March, April, May, getting really good. And then August, wow, they're feeding me even better. It's a really good life. September, wow, this is like the best life. Wow, in October, wow, they're feeding me twice as much as they did. He's got all this experience. How's that experience going to help him? November is going to be a shock, isn't it? It's like, wait a minute, doesn't. Well, that's kind of what he's saying here is that experience is actually leading you the opposite direction. So how do you handle that? You've got to just accept that. Workers' comp is another good example. Workers' comp claims are low during strong economies and they're high during weak economies. Why? When someone thinks they're going to get laid off, that's when they accidentally slip down the escalator and get injured. Why? Because they'd rather be at home on workers' comp than be unemployed. There's these correlations. So if you've been in a strong economy, that history is not going to be good going forward. Right? So that's right when exposure is likely to be exploding, right when experience is at its lowest. So the other one, he doesn't really talk much. I think it's implied here. So earthquakes are a little tough for this industry because they aren't that frequent. And I think the biggest problem with earthquakes is how the distribution works, that power log, a 6 versus a 7 versus an 8 versus a 9. It's not some linear thing. It's quite exponential. Same thing with terrorism risk. So terrorism definitely falls in the front. Can y'all think of others that might fit in here? We're going to talk boiler and machinery insurance. It's a very specialized insurance where very few insurance companies cover it because there's so limited data. That might be somewhere where you just don't have much history, so you just don't insure that unless you have that specialized information.
Sir, like in Florida, some of those apartments collapsed because of the sand and they've been exposed for years. Would that be property?
That would probably be covered by property insurance. Yeah.
Yeah, it doesn't happen all the time.
I don't know how it would fit in. You mean like in California or somewhere, or?
Like Florida, where condos collapse.
Oh, that condo, yeah.
Yeah, sinkholes too.
Yeah, you might look that up. I don't know what insurance company had that. That should be covered. Yeah. Yeah, I think through those and see which category. It's possible it doesn't fit in either category. I'm not sure. But think through some of the big events. I mean, that may be because we are talking about the most major events out there. I think you can probably think of more in this category than you can in the previous one. Now it is debatable. We will look later at NOAA. I don't know if y'all used NOAA. It's a pretty cool. Oh, I don't know how to spell NOAA. It's a pretty cool website. Have you ever been to NOAA before? You've seen their charts, I think. We need to move this class from the spring to the fall because all the hurricanes are in the fall. And so NOAA is always pretty boring. I mean, there's all the hurricanes right now going on in our oceans. But they do have the archives, and they're you can go back. So actually, one conference, World Conference I spoke at, I just took their annual charts that showed all the hurricanes and I just showed it over time. Just the question is, can you see any pattern? And there's, people say hurricanes are getting more frequent, but you really don't notice that. It's not an obvious thing over the last 50 years. I'm trying to find their archives link, but it's a really cool site. And we'll talk, especially when we talk about catastrophe bonds and how those function during a catastrophe, what the prices do. It's pretty interesting. So these sites are pretty interesting. You've seen them with the, where is it going to hit? So the question is, are we getting more of these? Because hurricanes, like hot water makes them stronger, but hurricanes also cool water. So there's a limit to a hurricane. At least they think so, not an earthquake. Earthquakes, we don't know how big earthquakes could be, but they do think there's a natural limit to hurricanes. Because when they hit hot water, they're stronger, and because they're stronger, they cool the water a lot faster, which makes them weaker, so they somewhat kill themselves. So they modeled that. That's something they can't do with earthquakes. They don't have that information. So the question on hurricanes is the number of them, but as far as the strength of them, they can model that pretty well because they know all the inputs to that. It also depends on how steep the coast is, how gradual the coast is, and those kind of things. So they have a lot more information. There's some videos. I used to have this class watch, but they took them down. They were really good. They were talking about the physics behind earthquakes and the physics behind hurricanes. And you'll notice they know a whole lot more about hurricanes than they do earthquakes. So that's why I think earthquakes fits really well in here. We just don't know. Hurricanes fits there, we're just not sure about the distribution. Now it's possible you could have changing laws or equipment, and that might be why you're talking about how we build buildings may have changed, what we build buildings on, changing car types like SUVs, like I mentioned, or speed limits and those type of things. We're going to talk about that more. There's a really great website I'm going to show you where they test all of it. What is the impact of airbags? What is the impact of distracted drivers? That's a huge one, isn't it? Is that a big change for auto insurance? It's distracted drivers make all that history on car insurance unreliable. I know when I ride my bike at 3 a.m., 4 a.m., if I see a car, I get completely off the road because I don't know if they're sleeping or on their phone or drunk or whatever. I get off. One guy got mad and came back and yelled at me. He said, "You're on the wrong side of the road." I said, "It's completely off the road. Why are you talking to someone at 4 a.m. in the morning?" But yeah, I mean, I worry about that as a cyclist, these distracted drivers. So there's things that fit into that. Those don't tend to be these massive events on the auto side. They tend to just increase frequency severities somewhat. So if y'all can think of others, that'd be great. I'd be really impressed if you can think of others that fit in these categories. And I like Kenny's idea, just go back and find some massive events and see maybe they fit in there, because that's really what we're focused in on, are these aggregate events, these multi-billion. You can very easily Google, and that might be something you could do, is largest insured events in history, and they'll come up with a lot of pretty little pictures and all that kind of stuff. So they're pretty cool sites. Yeah, that looks like Statista. Most of them are going to be hurricanes. And it's just going to be you're going to see Japan and those kind of things. So we'll look at some of these websites. I have some of them linked in the there's the earthquake and tsunami, 35 billion, 9/11, 40 billion. Oh yeah, you remember Katrina. Katrina had a bunch of buddies come along with her. That was a big year. A lot of these weren't insured though. Why was Katrina not, a lot of it not insured? I mean, a lot of Katrina was flood damage. Mississippi, Alabama insurance doesn't cover floods, so a lot of that wasn't covered. These claims might include what the taxpayer is paying. Financial crisis, I don't know exactly what they have in there. So you'll find these websites, they're pretty, this is not an insured loss, so I don't know why Lehman Brothers is in there. All right, so Experience versus exposure, you need to fully discuss that. We just did it here. You can watch the video after, make sure you got it. So a lot of students, it's just, they rely entirely on Warren Buffett, but there's more there. So you gotta drag out more stuff there from what we talked about. And then on examples, here's where this is probably the most missed thing on the paper. I want a real clear discussion on those two types of areas where experience can lead you astray. You don't have much data, or you have plenty of data, but the world may be changing. Okay, everybody sees that. That should be clearly in your paper, and give examples of those. Okay, I'll probably emphasize that again before. Even when I emphasize it over and over again, at least 60% of class doesn't do it. So it's a big part of the grade right there. Okay, questions on any of these? So what do I mean by clarity? If you go to the class notes, so on clarity, needs to be purposeful writing, clear writing. Make sure you state your purpose. So I'm going to do a review of Warren Buffett's 2001 annual report, talking about, make it really clear what you're doing. Should be well organized, good use of titles and subtitles, short paragraphs. That's the most irritating thing to me. I have students that turn in papers where a paragraph goes over three or four pages. It's horrible to read. So I wouldn't have a paragraph. I do encourage you to use 2 columns because this looks a lot better. If you use 2 columns, a paragraph really shouldn't be more than 10 lines. It just looks too long. If you're going to quote, and you can quote from this paper if you like, but a long quote, separate it out and italicize it. That may work more for that extra 10% where you're looking up something you want to quote from article and discuss it. Sources are important, although not on the Warren Buffett. I don't need you to source what you pull. If you quote from Warren Buffett, you can just say you're quoting from the annual report. I don't need you to source that every single time. You can just say, according to so-and-so article, January 2021, whatever, you can do it like that. I don't need a full-blown bibliography, but do make it clear. I had a boss that anytime I had quotes in the paper, if I didn't put the date the quote was said, he says, this is useless. This could have been, they could have said that in 1904. How do I know this is valuable to me? When did they say it? So that's important. And we're dealing with a pretty old article here back from 2001. Bold stuff, no fluff. So as they say, what's that famous saying? I would have written you a shorter paper, but I ran out of time. Your first draft should be the longest, and you get it much more in sync as you go. So I'll show you an example paper. Some of y'all seen this before. You don't have to use this format, but I really like this format. This is for another class that some of y'all took, right? This looks real familiar. I took it just last semester. I like this approach of an abstract that's say, what are we going to be doing? I like the 2 columns. I just think it looks more professional. What I don't like, oops, don't do that. I get a lot of papers that look like this. I can't say I count off for it, but it just looks so bad. Double space, I would never use double space. I know why y'all use double space. You want as many pages as you can get, but that's not your goal. In business, it's like, hey, boss, you just saw this, right? So John's got to sit through all this again, but hey, boss, I know you're really busy, so I could have given you a 3-page paper, but here's a 20-page paper because I used double space. I knew you kind of sit there not having much to do, so I thought I'd waste some of your time. No, you got to get to the point, and double space just doesn't it look like a college paper? This looks unprofessional, so no more double space. And then when you do 2 columns, very, very narrow margins, just so it looks more professional. So I like that approach. You don't have to do that, but boy, it just looks so much better to me. And you want to be writing papers you can actually put on LinkedIn. This first paper for our class doesn't work really well for LinkedIn because it's so specific, but you know, you want your papers, you don't want to write any more college papers because you're about to enter the professional workforce. On the critical thinking, professors get excited if students actually care about what they're writing about. You can let a professor know you care by adding some interesting phrases like, I find it interesting that, that's a good critical thinking type of phrase. I was surprised to learn that. I wonder if, so you're questioning the author. I wonder if Warren Buffett thought about this, or I wonder if he really means this or if he means that. I was curious to see if, I was amazed, that's kind of the same as that. I question if, that's really good critical thinking. He should also consider this. I think he should have thought about that. That's good critical thinking. Other items not in the article, outside readings. You might have something, this works really, really well, is you read a paragraph and it's somewhat confusing to you. It works better in my risk management class where they're doing a lot of heavy jargon paper. That first paper is really heavy jargon. To quote what they say and then say, what I think they mean here is this. That's a good way to, you're tackling some jargon and you're going to put it into your own words. That's a lot better than just quoting them because you don't know what they're saying and then hoping the professor says, okay, you know, I'll just trust that you knew what they were saying there. So that can work as well. Putting stuff in your, you know, those are all those critical thinking things. Don't go overboard and just put, I find it interesting that in front of every single sentence in your paper. That gets a little obvious. But so how do you get good critical thinking? Well, rather than sticking these into your paper randomly, step back and say, what did I find interesting? What was I most surprised about in this article? And then that might actually make your wording more interesting when you go back and reword that section and put that phrase in there. So a lot of papers I read are, I was really bored with this paper. I'm putting this down because I have to. Here's more stuff he told us to put down. That's kind of what I'm reading. I'm bored to tears because I'm reading the same paper 40 times. A student says, well, I don't think he's right on this. I would really question if that's correct because in my opinion, or I saw this on the website or whatever, that's when you get excited. And that's when employers get excited. I mean, you can talk issues like that, go beyond, because that's the reason they love hiring college students, because you come in and you're like completely wild, you know, you don't have any preconceived and you can question everything. That's what they're looking for. So start practicing that with a paper like this. Okay, can we leave paper one? Everybody feels comfortable? So you got a couple weeks. Great paper. If you're really scared, come to me during office hours and I'll make sure you don't have anything major, especially on the experience versus exposure, and try to help you. I've had some that probably picked up 5 or so points just by coming and talking to me. No more questions are good? What is, where is it different?
Yeah, on the top of the Word doc paper, it's February 18th, but in your syllabus link.
Oh, I'll double check and put it out there. It's possible it's even actually out there. Sometimes I copy the assignments over so you can see the date. I'll check, but it'll be clear. I do accept late papers, so it's not, it doesn't really, you know, it's a couple of days late, but I'll clarify. I was a little flustered because they keep changing the syllabus, and it takes me like 3 hours to do syllabuses because they keep changing. So I might have missed that one thing. So sorry, I'll check. Anything else?
You turn it in on Blackboard, I assume, or?
On Blackboard, yeah, I'll set up an assignment. Yeah. And I'll get it graded. If you turn it in on Friday, it'll be back by the next Tuesday. So I'll get it turned around pretty quickly.
If we're gonna coach you with questions regarding the paper, and we're bringing you a rough draft, I wanna ask how many rough drafts, would you want us to do before we just bring you any questions?
Well, try to get pretty close. Don't bring me like, I got the first paragraph done. So yeah.
Again, at least if you have it done, you know.
Yeah, you should have something you think you could turn in. That would be a gradable paper. Yeah. Try to get it pretty close to the end. I don't mind you coming more than once, but try to get it, if you come and I say, everything looks pretty good with this paragraph challenge, then maybe you come back just with that paragraph. What I really can't do is you email the paper and say, give me comments. If I do that, it's gonna be really high level and it's probably just gonna say, yeah, it's kind of there. Because what I can't do is fully grade a paper 2 or 3 times. It's just with as many students as I have. So you're better to come by, or you can call. You can set up a Zoom or call and we can go through it. So what I don't want to do is type comments too, because it's just time consuming. You can do a Zoom and you can record the Zoom and as I give comments, then you have my comments there. Right? Anything else? This is a really valuable thing to have read if you interview with an insurance company, because this shows some really good insights. I've had some students, prior students in this class say, yeah, this came up in the interview. They're really surprised we're talking that kind of stuff. So it is good that you're not just textbooky. All right. Now, as far as the second paper, there you get to pick your own topic. I don't know if it'd be a paper or not. We're going to figure that out as we get through the semester. Some popular ones from the past. Cybersecurity is always a popular one because that's really in the news right now, and that's a huge one, obviously. And you can find a lot on cybersecurity, but you can't write a paper on cybersecurity. You have to write a paper on cybersecurity and insurance. Okay, so it's got to be the insurance industry on cybersecurity. Driverless cars has died down a little bit, but there's still a lot of articles out there. What you might find, not so much driverless cars, but it's more the what does Tesla call it? How Tesla can drive for you.
Electric car?
Yeah, autopilot or something. So yeah, definitely. Even if we don't get the fully autonomous vehicles, just the fact that Tesla can take over for a few miles, and that's already causing some issues. That is an issue. I'll give you a few articles in here you can look at. Terrorism, I don't think there's much today as there was in the past on that, but you can certainly look. Regulation of auto insurance pricing is a pretty hot topic. Global warming is always a hot topic. Pretty interesting stuff out there. You now have insurance companies actually putting global warming in their risk section of their annual report. So they are talking about that. There are some firms that are actually putting driverless cars in their annual report, because if we go to true autonomous vehicles, people may stop buying cars entirely, which would wipe out this industry. Affordable Care Act. If you want to do a workers' comp issue, there are some pretty good workers' comp. I'm not sure Affordable Care Act is the best way to do it, but I think this one's actually more interesting, is the gig economy and work from home, and what's that's doing to workers' comp. I think it's pretty interesting. It's certainly killing the real estate industry in certain areas, but work from home, how do you do workers' comp when the workers aren't actually driving in to work? COVID was a big issue for this industry. Probably the best paper I've ever seen was one of my actuarial majors did a paper on COVID-19. She did it in 2020, so right after it happened, and it was just amazing. I was thinking, oh, she'll be able to find 2 or 3 things. She found like 9 or 10 really serious issues. So yeah, there's some stuff there, but there's some other stuff out there, and here's where you can really. So if you go to some of the websites, so AIR is a good example. AIR Worldwide. AIR, and in fact, this could be a good place to go for paper 1 even. So if you're looking for another issue, paper 1. So what AIR and RMS do is they build models for catastrophes like terrorism, like hurricanes, like earthquakes. And I love this button right here. Don't you all love these buttons? Insights. All these articles you can get. That can give you great ideas. You might find something there that would work for paper 1. I'm sure they have some terrorism related articles on here, but managing crop hail insurance risk, next generation modeling for direct. I mean, you see how specific they get. There's an experience versus exposure article right there, isn't there? Modeling fundamentals, a novel approach to training historical losses, severe thunderstorm. So some of these are probably a little too technical, but if you go through them, well, look at that. Modeling African swine fever's impact on livestock in China. That's huge, right? China killed, how many pigs did they kill? Millions and millions of pigs, pork prices went up. But did you know insurance companies were insuring these type of things? So there's a lot there. That's Air RMS. So Air started off as a hurricane modeler. RMS started off as an earthquake modeler, but they now both do everything. RMS has had some great videos in the past, and then they take them down. This is kind of somewhat irritating. Agriculture, builders, climate change. There's a whole section on climate change, cybersecurity, hurricanes, earthquake, flood. They even do the life insurance side, workers' comp. If you want to say what are the major issues in workers' comp right now, there's the whole terrorism side. How do you model terrorism risk? And there's 9/11 as their picture. They have a white paper on it. So there's a lot there. That might be something for paper one. I'm sure there's some stuff in there. Now, when you click on it, if the first paragraph has 7 terms you've never heard in your life, then maybe you have to click off and go find something else. So, you know, that's my reading style. If I read something and like I'm lost in the second paragraph, it's like, yeah, I can spend the next 6 years of my life trying to figure this out, or I'm just going to move over to a book that's not over my head. But yeah, there's some great stuff in there. You may have to ask them for permission. Another one I really like is Swiss Re.
None of those, excuse me, none of those sites that Air Worldwide and like that RMS website, none of those you have to pay for information.
Some of them you do. I don't think Swiss Re does because they're a firm trying to sell business, so they put their stuff out there. It's possible. I've seen some of them where you have to register, but it's just a free registration and you can get in. That's the way GMO is. So I haven't been on their sites since last semester, so I don't know. Here they have a place called Risk Knowledge. Swiss Re. If I were an actuary, that would be my dream job. I would want to work for Swiss Re. I remember they came in the USAA. I don't remember what they were talking about, but I was just sitting there going, wow, I wish I worked for this company. Not that I didn't like USAA, but it's like they're all happy. They're all very brilliant. They're so enthralled in what they were talking about. You think they were talking about, you know, the party they were at last night, but they weren't. They were talking about insurable risk. And oh, they were just so brilliant people. I was like, man, this would be the perfect work spot. Great company. But they do have information mitigating climate change. They do a lot of life insurance stuff as well. So there's a lot on the website as well. Maybe my favorite is the Institute for Highway Safety. If I can type any of that. Highway probably doesn't have U in it. So you've heard of these people. They're the ones with the crash dummies. Now, when I was a kid, they were famous because they had a famous commercial that y'all probably don't know about. But the crash dummies were like these stars, and they were talking about how hard their jobs were. Pretty hilarious. And they should bring that back because it's really good. But they do crash tests. In fact, if you're buying a new car, you might go to their site and see how your car's rated. They may even have videos. We're going to watch some of their videos in this class. There's a vehicle ratings. You can actually put your car in there and see what it is. But they're funded by the insurance industry. And what they do is they just test things. Airbags, anti-lock brakes, side airbags, front airbags. You can see all the stuff they do. Alcohol and drugs, distracted driving, that's a huge one. I'll show you a video later in the class that is funny and sad. It's a really great TV program. It's called The Worst Drivers in Canada. I don't know if y'all seen that one. Anybody seen that show? It's really scary program. I thought I'd seen The Worst Driver in my life, and then I saw the next season, and there was a lady on driver. There was the first one with this guy. He had broken his arm because he had a wreck because he was a distracted driver. And so now they show him, and he's got his hand in the cast, and he's on his phone. And it's like, yeah, it's a lot harder with the cast now. It's like, and I'm thinking that's got to be the worst driver. And then the next season, this lady, oh my word, there's no corner she didn't take under 50 miles an hour. Oh my word, she was just, and you kind of wonder if they're not egging these people on just for a good TV show. But distracted driving, all of them. The worst drivers were just constantly on their phones while they're driving, wreck after wreck after wreck. And you ask them, are you going to keep doing that? Yeah, I'm going to keep doing that. It's like just amazing. So what impact is that having? Cell phone use. Is it cell phone use? Does hands-free make a difference? Are we less distracted when we're hands-free? You know, those kind of things they're asking. So for paper two, there's a lot of, you could do your entire paper two by using this website because they have a lot of really good stuff. And they have videos as well. And we'll definitely use some of their videos. A lot of their videos are on YouTube. We're going to see some of their videos from YouTube. One I really like is comparing a car today to those massive metal cars from the 50s, and to see, and you can decide which you think is safer when you see them. One looks like a tank, one looks like a piece of aluminum, and you might be shocked at which one does better. It may not be what you might think just looking at the tank versus the piece of aluminum. So yeah, they do all those studies. I thought they had a link that said videos, but I don't see it here. Seat belts. They all know the history of seat belts. Good old Ralph Nader. People were dying in cars, and he became the seatbelt advocate. But teenage drivers, so pedestrians, so a lot of stuff there. So there's some really good sites. I think I put a few of them in here. There's RMS Air, Swiss Re, but there's a lot of research. This industry does a lot of research. It funds it. And so you can take advantage of that to find some really good articles for paper one or for the side on your paper two. If you do one of these, you're probably fine. Although I really don't think the Affordable Care Act is that, but I do think there are some good topics on workers' comp out there right now. In fact, I'm pretty sure we did workers' comp and work from home. I don't think workers has a 3 in. I'm sure you're going to find hundreds, if not thousands, 85 million. But I don't know what all that's referencing, but our telecommuters, I think that's an interesting one. Telecommuters. I had a boss who was constantly on his cell phone, and he required me to be on my cell phone. And we're going to see one case. If your job requires you to be on your cell phone 7/24, and you have an accident as a result where workers cover you. And we're going to see one case that they said this nurse, she was on call. She had to have her cell phone, and there's some mix up and caused her to have an accident. And yes, she got a workers' comp claim. So remote employees. So there's a plenty of there that could be pretty interesting. You can see some of these are coming from the industry itself. So start thinking about your paper too, just so you can, if you know what your topic is, you can find articles just as they come up. You might see something on YouTube, see something on CNN or something that give you some ideas, or start looking on at what's out there. Auto insurance, homeowners insurance, commercial insurance, they all have their big issues. All right, so let's spend a little more time on the economics of P&C insurance. You can really understand this industry. Any questions up to this point?
Does it seem like it's gonna be kind of hard to distinguish between life insurance and liability? For this paper?
Or liability? What do you-
Yeah, because like you said, all up on life insurance. Is it gonna be kind of that kind
Well, you mean for like a terrorist event?
yeah, or like any kind of
Well-
catastrophe?
Well, 9/11 was definitely a workers' comp, and that's property and casualty.
Right.
Workers' comp does provide life insurance. So workers' comp is a strange one where we're going to talk about that here. It probably belongs on the life insurance side, but because it's so tied to businesses and commercial, that's more what the P&C side does. Life tends to be more individual kind of stuff. So workers' comp, while health insurance, life insurance all moved to life insurance industry, workers' comp stayed. So even Oklahoma would be workers' comp type of claims, because there are a lot of workers in that building.
Right.
And workers' comp includes life insurance. You have to pay the person for their life,
So I
so.
just don't want to drift off topic to go into life insurance where, supposed to be.
Yeah, so you probably for an event you can't have an event that was in 100%, people died and they weren't on the job. That's gonna be entirely the life insurance industry, yeah.
Right.
And plagues, bubonic plagues, COVID, I'm not saying during COVID is definitely a life insurance issue because of life and healthcare. But COVID also impacted, people drove very little in 2020. Had a huge impact. Frequency came down for some reason, severity went up. Far fewer accidents, but the accidents we had were far, far, far worse. So COVID hit the auto insurance industry. Definitely hit workers' comp because you have all these workers that aren't coming into the job anymore. Yeah, so COVID, you don't want to do the health side, but there's a lot of property and casualty side. So yeah, make sure you keep it to the property and casualty side. So yeah, it's not an insurance paper, it's a property and casualty. Okay, so economics of P&C, as we said, severity and frequency is really the key. Frequency is, normally we think of frequency as the probability of something, but usually in property and casualty, when they talk about frequency, it's the number of claims. We're going to see that when we talk about credit scores. So frequency is how many claims were received. And then severity is how large the average claim was. And that gives you that expected loss. Expected loss is what we're going to see is when the insurance company sets their premium, the pure premium just covers that loss and nothing else. So the pure premium is the amount of your premium that just covers the loss, and then they're going to add expenses and profit and other stuff on top of that. So you're going to pay the pure premium plus another 30% or so. Okay. They're not going to charge you the pure premium because they never make any money. They take in $100 and they pay out $100 in claims. So the pure premium is what covers that expected loss. So a 22-year-old male driver. So what do we have here? Age, gender, type of car. I don't know if there's a such thing as 8-cylinder, 6-cylinder. So what do we know about someone like that? Young male drivers,
Reckless?
pretty bad drivers. You can see, you mentioned life insurance. You can actually see male drivers in the life insurance mortality table. Because mortality gets worse with age, except for a few years in the 20s for men. It gets worse because of driving. And then once they get out of their 20, for some reason, when you turn 25, you become a great driver. That second you turn 25, suddenly overnight. Sports cars, for some reason, red sports cars are even worse. So that's going to have a high frequency and a high severity. It's going to be very, very expensive. If the probability of an accident is 2%, I don't know if that's accurate or not, and the car is worth $50,000, and the expected loss is 2% times 50,000, $1,000. The insurance company's gonna have to charge $1,000 just on basic, just to cover their claims, and then they'll have to add another $200 for expenses, another $100 and something for profit. So there was a book I was tempted to use for this class, but in the first chapter they said the reason insurance works is they can charge a premium that's less than the expected loss. And it's like, no, that's not true. You go out of business if you do that. So I'm not sure why they said that. I think they were mixing up gross premium with pure premium. So the insurance company's got to charge you at least that. And that's why I say anytime you buy insurance, it's a loss. You're losing money. If you didn't buy insurance, on average, you would expect to lose $1,000 a year. Now that $1,000 a year would be what? 0.0000000 50,000 0.00000, but on average, it'd be 1,000. If you buy the insurance for $1,400, you're going to pay $1,400 every year. You would have been better off not buying the insurance. If you don't buy the insurance, your expected loss is $1,000. You buy the insurance, you know for sure you're going to lose $1,400. So why do you buy the insurance? Well, because that $50,000 is so painful, you're willing to pay an extra $400 even though you know on average you're worse off. So insurance works mainly because we're so loss averse. We hate those large losses. We're willing to pay more than the expected loss in order to eliminate that tail risk. So insurance is, you cannot do a net present value discounted cash flow of insurance. You will always get a negative number. The insurance company, unless for some reason you're a horrible driver and they don't know it, then you win, but they're going to figure it out pretty quickly. After like your 10th claim, they're going to say, okay, we got you in the wrong category. We're going to charge you more. Same thing with life insurance. It's a losing proposition when you buy life insurance. You're going to pay more than what you expect to get back on average. Now you can win, right? You buy it and you have an accident tomorrow, then you win. But on average, you're expected to lose, right?
So with this, car insurance, I know like USAA, they have the safe auto pilot or whatever. The once you have the phone, that tracks you, the bigger your discount is at the end of the month or at the end of your 6 months or whatever. Isn't that gonna change the equation basically, because I'm being such a safe driver now, why am I included with all these other bad drivers who these 22-year-old males?
Yeah.
driving around fast?
We're going to talk about that. USA, one of our students from this class, that was her job, is to figure out how telematics is, and that's called telematics, if you've heard that term. So her job is to figure out, does telematics change our premium? So there's two questions they had. First of all, the information we get from telematics, does that tell us more about the driver that we can distinguish which category? Secondly, the fact that they have telematics, does it change the way they drive? So one is just, we want to see what kind of driver you are. The other is, have we actually changed? And the third thing was, does that wear off over time? The first 3 months, boy, you're just focused in on it. The first few months, it's irritating me because I'm on a bike 3 to 4 hours every single day and it thinks I'm in the car. So I have to go in and say, no, I wasn't the driver. That's irritating. I've kind of stopped doing that because it's so much, because it's not like one bike ride. My 4-hour bike ride, they have that as like 7 trips.
Yeah.
And I have to go in and delete each one of those. It's kind of irritating, but I want my phone on, I want to use, I don't know how to actually turn that off. But they are testing that, and that's actually would be a good paper too. I've had a few students do on telematics. How's this going to change? We're going to bring up telematics when we get the credit scores, because that's going to be my argument on credit scores. If you have a false positive, so what is a false positive? Someone with a bad credit score that's a really good driver. And they're like, that's not fair. Yeah, I have a bad credit score, but I had some unusual things, but I'm a really good driver. You're saying I'm a bad driver because of bad credit scores. So what could that person do? Telematics might be their solution. You say, okay, I can prove I'm a good driver because of telematics. And you say, okay, 6 months, and we'll give you that discount. So telematics might actually radically change this industry. I don't think we're sure yet because we're still collecting information. That's why I say if you did telematics, the root insurance company, that's what they do. So that's their whole model, is to rely entirely on telematics. So you come in, they're going to charge you a really high rate. They'll give you a few months on telematics, and if you prove you're a good driver, then you get like a really good rate. So it's an interesting firm. You could definitely work them in to your, if you did a paper 2 on telematics, they would be a good company to do. I don't know how their rates compare. I've been tempted to kind of test and see where they are on their rates. Obviously, if you get an insurance company that has the design of the product, they only have good drivers, that's going to be a pretty enviable insurance company.
The only reason why I asked is, my insurance, I dropped a little bit because, I was driving safe for 6 months or whatever.
Yeah.
And it dropped a little bit, so it wasn't too bad. So that's just why
They sent me a message just a few months in. They said, you completed your first period. It was too early. So they shouldn't send me anything, but they say, congratulations, you're just kind of 0%.
Yeah.
Like that's really good marketing. Someone needs to write their program, not send that out, because that's not all that encouraging. All right, so why is this so important? We're going to get into this a little bit more, but if insurance is a loss, you don't want to buy too much of it. So you want to buy the right kind. So we're going to talk about when you should buy it. if you know it's a losing proposition, you don't want to unnecessarily buy this stuff because it's just not a good financial decision, except in those extremes. So on average, you lose. It's an inefficient industry. Some of y'all saw that. Took me last semester. Insurance is very, very expensive. So last semester, I forget who was in there last semester. Might have lost everybody last semester. Oh, Josh will be in there. So remember that paper, you know, the insurance industry wants to do investments, the life insurance side. They want to be on the investment side. Why? Because that's where all the money is. But they're terribly inefficient. They have to charge a lot. You know, mutual funds charging 0.5%, 0.6%. Life insurance, they're charging 1.8%. Why? Because they have actuaries, they have underwriters, they have all this, they have all these huge expenses. So not only are they going to charge you more than your expected loss, but you're going to charge a whole lot more because it's in a very expensive business to run. Not because they're just, you know, they're not controlling their expenses. It's just they have to hire. Actually, we have some actuaries in here. Actuaries are expensive employees. Fidelity, Vanguard, they don't hire actuaries. They don't have underwriters. So it's an expensive business. So we're going to ask two questions. The first one's pretty straightforward. The second one's going to be an exam question, which is, I usually have at least one essay question on the exam that's really oddball, and that's the one. But I love the question because it takes what we're going to talk about in insurance, and then it takes the stuff you learn in finance and it puts it together into a really good question. But we're going to answer we're asked three questions. When should individuals buy insurance? Then we're going to ask, when should corporations buy insurance? We're going to see that that answer is radically different than the first one. In fact, we're going to come to the really amazing conclusion that corporations shouldn't buy insurance, and we'll see why that is. And then the last one is when insurance companies can sell insurance. You've somewhat already done that with Warren Buffett, which is, you know, something you can evaluate, avoid large losses, those kind of things. So those are the three questions. So we'll start with this first one, and the key here is frequency and severity. So before we look at it, what do you think you want to buy insurance for? High frequency events or low frequency events? So you might say high because that means you can cover a lot, but remember, every time you pay, you're going to pay extra. So it should be low unless it's mispriced. So low frequency. Why? Because insurance is extremely expensive. You want to use that insurance company as little as possible so they keep their costs down. They don't have to charge you so much. What about severity? You want low severity events covered or high severity events covered? High severity. Low severity events, you're just wasting your money. I think I saw John Stossel talking about this with health insurance, probably the worst insurance there is. He says health insurance, doctor's visits, those kind of things, that's like buying insurance for your groceries. So you go grocery shopping pretty frequently. It's pretty low severity. And insurance company, hey, we got a policy for that. If you ever have to buy groceries, we provide you the groceries. So if you on average spend $300 on groceries, if you have this policy, it's a $400 policy, it gets you those $300 in groceries for free. Everything's covered. You can only buy the groceries on our list, though. You can't buy other groceries. You pay us $400 a month, and you have all of your grocery risks covered for the rest of your life, up to $300. Doesn't sound like a very good policy, does it? What should you do? Just buy your groceries for $300. Is there insurance like that? Yeah, there's a lot of insurance like that. Some of you are probably buying it, so we'll talk about that. But definitely, because this industry is charging you more than you really should be paying, you want to use it infrequently. So you only want to cover those things that happen very infrequently, and when they happen, they're pretty severe. Otherwise, you're just throwing your money away. So we'll start there next time on Wednesday. Okay, so I find this section really interesting because it's very unique to this industry. Even like on the life insurance side, there's a little bit of application on the life insurance side. The three questions: when should an individual buy insurance? When should corporations buy insurance? And when can insurance companies sell insurance? So the first question is very straightforward. It all has to do with frequency and severity. So let's start with something that doesn't happen very often, and when it happens, it's not all that expensive. So not appropriate for insurance because remember, you're always paying more than you expect to lose. So you're just paying extra dollars for no reason when you do that. A good example of that would be warranties on low cost items. I think towing and labor fits into that. I think I had one claim my whole life where towing and it's not just you need towing they're going to take, because if it's mechanical issue, you got to pay for your own towing. So it's an insured event, an accident or something like that, they're going to tow you. I think I've only had one of those in my life. Towing's maybe $10 a year, but if you add it up over 30 years, I'm still way ahead by not buying the towing. Warranties, I don't buy warranties because I know they're losing. Another reason you know warranties is a bad deal is how hard they're pushed when you buy something in the stores. Why are they pushing them so hard? There's some products, that's where they make their money. I always tell students the one time I remember it, I went to cons. My black and white TV had broken down. I was on the credit union board, and they gave us all these small black and white TVs, and the one I had finally broke. So I went to cons, buy another one. It's like, I don't know, just itty bitty thing. I think it was $16. So I buy this, I go up to the front and he asked me, do you want insurance on that? I go, insurance on a $16 TV? I said, yeah, it's $7. Like, no, I'm not going to spend $7 on a smart. If I drop it in a parking lot, I'll just come back in and buy one and go back home. And it's like, who buys this? And he laughed and said, yeah, but do you want it? And I was like, no, I don't want it. It was ridiculously mispriced, but you can see why they want to sell that. That would make a lot of sense. Now, not to step on any toes, I think smartphone insurance is the same way. Some of y'all might want to convince me on that. I know people that absolutely are religiously fervent about buying smartphone insurance, but always remember it costs more than what they're going to pay you on average. It always has to be. There's no way anyone's giving you some great deal. They're going to, on average, pay you $50 and they're only going to charge you 30. That's not going to happen. So you know it's always a losing proposition. If it's an item, now for some people, if it's a $500 phone, maybe that's such an expensive thing. Yeah, they need to buy the insurance just in case. But if it's something you can afford to buy, even if it's maybe a little bit of a, a little expensive, you're better off not buying these kind of things because they're priced to make you lose on average. The best thing to do here is retention, loss control, just manage the risk, right? Avoid reasons for having to have those happen to you, but ultimately you just pay for it out of pocket. So, and then something that happens all the time, and when it happens, it's not all that severe. So definitely not appropriate because it's going to be a lot more expensive because the insurance company is doing a lot of stuff because there's a lot of claims. So they're going to be charging you a lot of money to do this. You're much, much better off not doing this. One of my least favorite of all insurances is dental insurance, because for a lot of times when you buy dental insurance, you have to pay for the dental cleanings. If they just sold dental insurance for root canals and major surgery, that would be fine. But dental cleaning, you're going to spend $100 for dental insurance to cover your $70 dental cleaning. It just doesn't make sense. And you go to the dentist twice a year, so you're gonna spend $200 on insurance to cover $140 worth of cleanings. The other thing I don't like about it is, when I go to the dentist, I hand them a credit card and I leave, and that's it. The whole thing's over with. If I hand them my insurance card, now they got to take all that information. They now have to file that claim. I mean, it's a lot of work. There's a lot of stuff going on here that is just adding costs. It doesn't just add costs for the insurance company, it adds costs for the healthcare provider. So it's a lot of costs for something we should just pay out of pocket. So it doesn't make sense to me. And in my class last semester, those that took that class, so Josh, remember, he's worried I'm going to go off on one of my tangents, but yeah, health insurance is terrible. We should not be paying for doctor visits with our health insurance. Now, some people argue that it makes sense. I remember President Obama was arguing it, and his argument that you hear a lot is you want to pay for people's checkups through health insurance to encourage them to get a checkup. That way you'll catch stuff early. And Josh, you remember on that one is you don't want people to do that because a lot of times they catch stuff that won't hurt you. And they're going to give you surgeries that you don't need that wouldn't have hurt you anyway, because they're going to find a lot of stuff that's not all that dangerous. So even that is a debate, but yeah, health insurance needs to cover major surgeries shouldn't be covering your annual checkup. It just doesn't make sense. There's no value that the health insurance company is adding to that transaction. They're just adding costs. It's not like they're out there using their buying power to get you really cheap doctor visits. No, they're not adding any value. So here, out of pocket, self-insure makes the most sense. Now, this next one, you might say, wow, this would be good for insurance. It's something that happens all the time. When it happens, it just destroys you. Well, the problem with that is the insurance company is not going to want to write this because it's going to cost them a fortune. And if they did, it's going to cost you so much that, you know, you're better off not doing it anyway. So if your house is going to be destroyed by a hurricane every year and you have a $500,000 house, they're going to charge you $550,000 for that insurance. There's not going to be any benefit to you buying that insurance. So really sick people buying life insurance, the insurance company knows that. They're not going to sell you a $100,000 policy if they know for sure you're very, very sick. Building a house in a floodplain, we'll talk about that one. A 16-year-old driver might fit into that category. I did my parents a huge favor by waiting a year and a half before I got my license. I don't know how much to save them, but probably enough for a couple of semesters of tuition. Yeah, young drivers. I don't know if y'all have any of y'all know what you cost on your auto insurance when you first got your driver's license. Anybody tell you how much your rate went up? My parents never told me, and they paid for it. You might have paid for your own. Anybody know what a 16-year-old, 17-year-old driver? What's the age in Texas for driving? Is it 16? By yourself or still with the learners? You can drive regularly at 16.
Specific permits for whatever.
Oh, if you have a special, yeah. So, yeah, I can't even imagine how much that insurance is. It's got to be pretty. You're almost. I don't know what percentage of 16-year-old male drivers have accidents, but it's got to be a pretty significant percentage. Life insurance for people that are in combat. There's a lot of insurance companies don't cover war risk at all because of that, because there's a higher probability. So here, risk avoidance is probably the best thing. You know, if you're building a house on the coast and there's hurricanes constantly, you're probably better off just renting a place or renting a condo or something, and just avoid living there and then retain. So here's where insurance is set up, and it works really well. Low frequency helps keep the costs down. The insurance company doesn't have to manage all those claims. In high severity, you're still going to pay more than the expected value, but it's going to save you in a year where, it would just completely wipe you out. And so that's the perfect use of insurance. It's fairly affordable. Term life insurance is a good example. A 20-year-old, 25-year-old buying term life insurance, it's going to be really, really, really cheap because the probability of dying is really, really low, very few claims, and it provides incredible protection to your family. So you hardly notice the cost. And then if it happened, it's really, really, really good. Another way you can think about this, though, on frequency and severity is your limits and deductibles. One thing you can make it lower frequency and higher severity, which will greatly reduce your costs, is to go with higher deductibles. And so this brings up this concept of rate online. It's a concept I really love. So rate online is how much additional premium are you paying for additional coverage? And you should all go do this with your auto insurance. I think I actually got the numbers, but I don't have them in here. I have to find the numbers. I'll try to do it when we get the auto insurance. I'll show you. So, so you have a $1,000 deductible, $500 deductible. Oh, I do have it in Excel. Did I put it out there? I completely forgot about that. Let's see if I can find it. I can't remember if I did it or not. It's probably out there under miscellaneous. Let's see if I remember to put it out there. There we go. Well, it's been a year since I've taught this class. Forget. It's out there. All right. So these are actual numbers from USAA. I don't know if your insurer does it, but USA, you can go in and try different coverages and they'll tell you what the premium is. So $100 deductible, that's a really low deductible. My premium, I think this was a 9-month policy or something. I can't remember, but my premium $476. So I'm getting from going from 500 to 100, I'm getting an extra $400 of coverage. Everybody see that? I reduced my deductible from 500 to 100, but I'm paying an extra $140 for that coverage. I'm going from 336 to 476. That rate online, my additional premium versus how much extra coverage I get is 35%. That's a really high rate online. Going from 1,000 to 500, I'm getting an additional $500 in coverage, but it's only cost me $47. That's only a 9% rate online. All right, y'all see, y'all could all do that. Now, what's the rate online for you? Well, there's no rules on that, but 35% is pretty high. You're paying a lot for that coverage. So now I have, I think I have 1,000 deductible right now. And when my last car hit 10 years, I just completely got rid of the deductible. I mean, I just got rid of the coverage entirely. I just figured, hey, if I wreck the car, I'm just going to hire Uber and go buy a new car and go home. So, if the car was worth a few $100s, why buy insurance? So I definitely don't want a deductible to be worth more than my car. That's kind of a waste of time there. And there's other things in your car that could be covered, but a lot of that's covered by homeowners. So don't think that, hey, I've got $2,000 in golf clubs. That's not auto insurance. That's homeowners insurance. So old cars may not need this property coverage. But try this with your insurer. It makes a big difference. You can see how much cheaper it gets as you raise up the deductible. It's pretty material going from 100 to 500. Can save you quite a bit of money. All right. This rate online is important for other things. So Warren Buffett was talking about reinsurance, where the deductible is what, $1 billion, and then they cover you over that. Those premiums can be really low as a rate online because you're highly unlikely to hit $1 billion for a terrorist event or something like that. Very high, like maybe talking 1-2% type of rate online. But it's a good way to think about whether or not you should buy higher or lower deductible policies. I'm glad I put that CXL in there. I completely forgot. I knew I had the numbers. I just can't remember where I put them. All right, so pretty straightforward. So let's go to the not so straightforward questions. So this will be an exam question. So we better, make sure everybody's comfortable with this. So before we can talk about whether corporations should buy insurance, we got to review the most famous formula in finance, which is the capital asset pricing model. Everybody remember that? Does this look familiar? Y'all all seen that? Everyone at least once? Risk-free rate plus market times market risk premium times beta. You can read his article about it. Good old William Sharp. So it's called CAPM, the capital asset pricing model. Terribly titled. It doesn't relate to capital assets. It only really relates to stocks. So it doesn't relate to bonds and real estate. It's not a pricing model. It's a cost of capital. And it's not a model, it's a formula. But other than that, it's well titled. But that's how we know it, CAPM. So what would CAPM have to do with this particular question? So on the exam, it's a tough question. I love these correlated questions because it makes you really have to understand not just this class, but also apply finance you learn in other classes to this. And this is a perfect example of how to apply the theory of finance to a problem like this. So let's review CAPM real quickly, just to make sure you have it. So beta is a measure of relative systematic risk. Relative. Why do I say relative? Because the market's at 1 and you're relative to that. If you have more systematic risk, you'll be above 1. If you have less, you'll be point below that. So Walmart might have a beta of what? What would be your guess? How much less do you think? Grocery store, but they do sell some TVs and computers, maybe 0.5, 0.6. Walmart's interesting because they did well in 2008 and did well during COVID. They've been the place to go in the last 2 crises. But yeah, Walmart's a fairly low beta company. Ford Motor Company, probably pretty high beta company. Why? Because we're talking about systematic risk, and the most systematic risk there is the economy. Or is it a cyclical company? In that case, it's going to have a high beta. Is it a defensive company? In that case, it has a low beta. But the key here for the exam question is what beta is measuring. It's measuring systematic risk. Total risk has two pieces, systematic and unsystematic. This is the key to the question, this unsystematic part, all right? So systematic risk, you can't reduce it by just adding more stocks to your portfolio. If you got 20 stocks, going from 20 to 40 is not going to change your systematic risk unless you specifically put defensive stocks into your portfolio. If you just randomly throw another 20 stocks in your portfolio, your systematic risks won't change unless it's just pure chance. But if you have a high beta portfolio and you throw low beta stocks into your portfolio, then you reduce your beta. But just randomly adding more, just diversification, that doesn't. The economy is the most systematic risk there is. And this is important to the exam question as well. You're going to see when we tie this back to insurance. So recession, is the stock expected to perform better than the average company or worse than the average company in a recession? I think about revenues, whether revenues fall more than average or less than average if you go into a recession. There are other systematic risks like interest rates, inflation, the market itself. That's what CAPM is looking at. The market itself, CAPM says the market itself measures all these risks. So we'll just correlate the stock against the market and figure out what's the slope of that. Commodity prices, demographics, there's all kinds of things in there. And then y'all know this from those that have my previous classes, beta is not a number you get from Yahoo Finance. It's a forecast. It's a number, and we won't cover this in this class. You can look it up in Yahoo Finance, but very, very unreliable because all Yahoo Finance is doing is looking at monthly data for the last 5 years. That includes COVID, includes some periods that can really skew those betas. So you got to be careful. If you looked at bank stocks in 2008, their betas would have been really, really high. If you look at tech stocks in 2000, their betas would have been really, really high. So you have to be real careful just looking it up. And betas are terribly unstable. That's one of the biggest problems with this theory is if you're looking at a stock's exposure to the economy, you think that'd be fairly constant. It's not like Ford sells cars and the next year it sells baby wipes and then it starts selling cars again, then it starts selling bread. No, it's selling cars. It's pretty constant, and yet its beta can move around. I saw once on Yahoo Finance, Ford's beta was 0.65. It's like, okay, that's not a good beta for Ford. It's way too low. But for that one little period of time, they just happen to have a very low beta. So the only way to reduce systematic risk is to take less of it. You can't just diversify it away. You have to buy lower beta stocks, sell high beta stocks. All right, so we'll get back to why that one's important, but even more important is this unsystematic risk. Unsystematic risk of those things are specific to the firm, or maybe even industry specific. They're easy to diversify. I mean, really easy to diversify. You can completely eliminate unsystematic risk by just buying 30 to 40 stocks. As long as they're in different industries, your unsystematic risk goes to zero. And that's really, really key. You want to add that to your answer. This idea that you can eliminate it. There's a few concepts here. Both of these words are very, very important. Easily and eliminated. I didn't say it can be reduced. I said it can easily be eliminated. So it's not like you can reduce it with a lot of work. No, you can completely get rid of it with very little work. In fact, you can do it all in one phone call. You just call Vanguard and buy their US stock fund, and you've eliminated, in one phone call, you've eliminated all your unsystematic risk. And so what William Sharp was arguing, if you remember this, he said, when investors are pricing stocks, they should use a discount rate that only reflects systematic risk. They should not be compensated for taking unsystematic risk because that's so easy to get rid of, so inexpensively. The market should only compensate you for taking systematic risk. Okay, y'all remember that? Previous classes, very, very important concept in finance. It's not one we teach well because when I interviewed a lot of finance majors, I always liked this question, talk about CAPM and beta. Just talk about it, free form. I remember I talked to graduate finance student from Yale. I'm thinking, oh, he's going to blow me away. He had no clue what CAPM and beta were. I was like, oh my word, you went to Yale. But so there's a lot of students that are completely missing. This is fairly foundational to a lot of finance. So William Sharp said, unsystematic risk, easy, just add more stocks to your portfolio. It completely goes away. Very easy to do. You're not going to be compensated for taking that risk. So if you put all your money in one stock, there's a lot of risk you're taking that you're not going to get paid for unless you just have some insight in a company no one else has. That's a really unwise thing to do. So the discount rate you use, the value of stocks, should only include systematic risk, not unsystematic risk. And the amazing thing is unsystematic risk is the bulk of the risk of a stock. 75 to 85% of a risk of a company's public company is unsystematic risk, which means you're eliminating an enormous amount of risk. If you buy Apple and it's your only stock, and then you sell some of it and move it into a well-diversified portfolio, 75, 80% of the risk of Apple just disappears. All right, some of y'all have heard this example I give, but I'll do it again because I think it really is insightful. So HEB, public or private? Private firm. So CAPM not apply. Why doesn't it apply? Well, Mr. Butt cannot diversify his risk to HEB. He can't put it in all the, it's all he's got. It's his company. So his discount rate reflects total risk, systematic and unsystematic. He has to worry about HEB itself. And it's particularly when Walmart's doing whatever, Albertsons comes back in town, whatever. They got to worry about that. So valuation will be very low. I don't know how low, but let's say he does it, he comes out at 500 million. And then HEB goes IPO. What's going to happen to the discount rate to value HEB? It's going to fall dramatically because remember 75, 80%, 85% of the risk is unsystematic risk. And this is a very low systematic risk company. So their discount rate is going to fall dramatically. So valuation will soar. Let me get the right soar here. Say maybe, I don't know, 25 billion. Overnight, if HEB goes public, the HEB family's wealth will go up 10, 20, 30, 40 fold. Just overnight. Now, why don't they do that? I don't know. Well, I think once you get 10, 20, 30, 40 butts walking around 3 or 4 generations from now, they're probably going to sell. You split 500 million among 10 people, they may say, oh, we got enough money. You split it with 500 people, then suddenly they're saying, hey, let's go public. Let's increase. I mean, it's pretty tempting, isn't it? Mark Zuckerberg went through this. It's like, I really don't want to go public, but I'd rather be a billionaire than a millionaire. So let's go public. So that's what we're saying here. It's that discount rate. It doesn't apply to everything. So if you're not a publicly traded company, if you can't be in a well-diversified portfolio, this CAPM doesn't apply. So we're talking about publicly traded companies. So any questions on that? So the question is how we tie to the problem we're going to address, but that's going to be extremely foundational. I gave you the formula for beta, covariance divided by the standard deviation of the market squared. It's essentially the slope of the company's returns to the returns of the market. That slope is steep, your beta is above 1. If it's flat, it's below 1. Y'all probably did that in some of your classes where you did the graph and you showed the slope line. It's unbounded. Duration can be negative 500, it can be positive 500 or 5 billion. It can be any number. So it's a little different in covariance. They're almost the exact same definition. It's just that covariance, you divide by the standard deviation of the market and the standard deviation of the market. But beta, you only have the market risk. All right. So what in the world does that have to do with corporations buying insurance? So the first thing you want to, so if you explain this up here, the theory of CAPM, CAPM says you can ignore unsystematic risk. And so now you get to insurance. Most risks covered by insurance are what type of risk? a warehouse burning down, a liability lawsuit,
Systematic.
unsystematic. Most of them are unsystematic. Why did CAPM just say about unsystematic risk? They disappear with diversification. Right? Now, not all. We'll get back to that. There are some risks insured by insurance that could be classified as systematic. So we'll come back to those. But the majority of the risk are unsystematic risks. They're very specific to the corporation. All right. So theoretically, stockholders are better off if you don't buy insurance. First of all, if it's unsystematic risk, stockholders don't want management spending money to eliminate a risk they've already eliminated. I'll see that argument. Why spend money on insurance if that risk is eliminated in my portfolio? I don't have to worry about it. Okay, that's the first one. So for unsystematic risk, they've already eliminated that risk. Don't spend money on something I've already taken care of. Everybody see that argument? But then you say, well, yeah, but then some of these risks are systematic. Well, what about that one? Do we care about that? So let's see if I have that file out there. I used to call this a Toys R Us example because I used Toys R Us and they don't exist anymore. So I had to stop using Toys R Us. All right, so this is a wild example, but it really, I think, brings it home. So let's say you have the insured Toys R Us, whoever it is, a Walmart, and you have the insurer. So maybe this is Walmart and this is Chubb. All right, let's say Walmart has $1 billion in revenues and Chubb has $500 million in revenues. There's their expenses, there's their net income. And let's say Walmart has a $500 million loss or something burns down, whatever. So their net income with that loss drops to negative 300. Chubb's not insuring them yet, so Chubb still makes 100. All right. So let's buy some insurance. Okay, everybody with me here? Walmart with a loss, they would be off 500. Without a loss, they make 200. They have the $500 million loss. They lose 300. Ignore taxes for this reason. Chubb doesn't care because they're not insuring them yet. All right, now let's say Chubb insures them. So their revenue and expenses are the same, but Walmart now has to pay 50 in insurance premiums. So what happened to their net income? Without a loss, their net income goes from 200 to 150. Is everybody with me on that? What happens with Chubb? Well, Chubb's revenues go up 50, but look at their expenses. What do their expenses do? Now, these numbers are a little skewed, but it's the principle. What were their expenses before? 400. Now they're 420. Why are they 420? Because they have policyholders, they have underwriters, they have to set up the policy. They're going to spend extra money. That's probably way too high for a $50 million premium, but they're going to spend extra money to take care of Walmart. So their net income doesn't go up 50, does it? Their net income only goes up 30. What happened to your portfolio without a loss? If you own Walmart and Chubb in your portfolio would have had a net income of 300. If Walmart buys insurance from Chubb, what happens to your portfolio's net income? Falls 20. Why? Because Chubb had to spend money to manage this. All right. We say, well, that's without a loss. Well, if there's a loss, then it's going to work out. So let's try that. So Walmart, income, expense. Chubb's income's higher by 50 because they got the premium. What do you notice about their expenses now? They're going higher. Why? Because now they have adjusters, they have lawyers. So the expenses go more because they have a claim to handle. There's the warehouse buy, but Walmart gets 500 million from Chubb. They're pretty happy, aren't they? They're glad they bought the insurance. Well, what does Chubb have to do? They got to pay the claim. They're out 500 million. What happens here? Your net income is down 250. If you just had the loss, your net income would have been negative 200. But because Walmart bought insurance, your portfolio is off by 250. Why? Because Chubb had to spend $20 million to set up the policy, another $30 million to adjust the claim. And is there any way you can be ahead in this transaction? The only way is somehow, you can break even if somehow Chubb can do all of this without costing them any money. Is that possible? Do you think Chubb can have a major customer like Walmart, not spend any time on it? So this is what I call expense leakage. On the exam, you got to explain expense leakage. You can't just put it in there. What the expense leakage is a company buying insurance requires that insurance company to hire people that have to handle that claim. If you had just left it out, your portfolio would have just had the loss, which would have been bad. But now with the insurance, you have the loss, plus you have those people the insurance company had to hire to manage this whole operation. You cannot come out ahead of this. Now, how some students say, well, we just won't put insurance companies in our portfolio. Well, that's kind of bizarre way of managing a portfolio, just avoid this one little kind of strange phenomenon. But from your portfolio standpoint, this is all left pocket, right pocket, because the insurance company either gets the premium, doesn't pay the claim, gets the premium, pays the claim. If they pay the claim, Walmart is it's just left pocket, right pocket kind of stuff. So even with systematic risk, there's this left pocket, right pocket thing going on. You really can't get around. So even with, we talk about D&O insurance, it's probably systematic. Terrorism could be systematic if it's large enough. Workers' comp, there are some that Walmart eliminating those would make them lower beta, but then they're going to shift it off to Chubb, which is also in your portfolio. It's going to increase their beta. You're going to end up worse off, or the same on beta and worse off after expenses. All right, so for unsystematic risk, stockholders say, hey, we can do that ourselves. We don't need your help management. For all risk, you got the insurance company and the insured in your portfolio. You're just left pocket, right pocket kind of stuff. I call that expense leakage. That's my term. That's not don't use that in an interview unless you're going to fully define it, because that's mine. But remember, insurance companies are very expensive. Underwriters, actuaries, adjusters, these are very expensive people that other companies don't have. And they do have to be hired to manage these large clients. So I like this way I worded it here. You don't want management spending precious corporate resources to mitigate a risk that you, the investor, already mitigated via just simple diversification. Now, real important in your answer is how you handle these words like they and you or whatever. Make it really clear. I have some students that don't know who this person is. It's the investor we're talking about. We don't want management buying insurance, spending the resources of investors for a risk the investor have already diversified. I have some students that say, we don't want them spending money on a risk management's already diversified. Management's not diversifying their risks, they're diversifying the stockholders' risks. So make sure you got the right people here, because management is actually going to be in part of this next part of the question. All right, I did that fast. That's a lot to sink in. So what's part of the answer here? So you've got to do some definitions up front on what CAPM is, what the theory is, systematic, unsystematic risk, diversification, that all needs to be in there. It's in my discussion here, but it needs to be in your discussion. And that should be easy, because you should know that, because you probably get CAPM in almost every finance class you take. You're probably tired of hearing CAPM. Well, you took John Toohey's fixed income class. He may not have taught CAPM once in that class because it doesn't really apply to bonds, but definitely most corporate finance, your investment classes, CAPM comes up. So hopefully you already know this. So you got to build that first. And then where a lot of students have struggled with this question is how to take that and tie it to what we're talking about here. Okay. So you define CAPM, you define systematic and unsystematic. Then what you got to do is make this extremely important link. So CAPM talks about systematic, unsystematic. What is insurance covering? Is it covering systematic risk or unsystematic risk? Well, most of the risk it covers are unsystematic, which means it's covering a risk that the stockholders, not management, that the stockholders are already eliminated. And then you can talk through that. So stockholders won't management spending money to eliminate a risk they've already eliminated. However, there are some risks that could be considered systematic. By eliminating them, the firm could actually reduce its beta, increase its value. But even on those risks, if the insured and the insurer are in the portfolio, it's just left pocket, right pocket, plus additional expenses the insured incurs. You're not buying anything. There's no way to come out ahead on that. All right, that's the skeleton of it. What I recommend you do as we get closer to the exam is write out your answer. If you're not sure, come talk to me to make sure you have all the pieces. Because some student, I think part of the problem is you won't look at this again until right before the exam. And then it's going to be like just this big blur. So you might put in your notes that 15 minutes into this class is when I went through this question, so that you know to go back and watch this part of the video, because it is a tough question. I love it because it really shows an understanding of CAPM and of insurance. It's got them both in there in a really powerful way. All right, what part of that was the most confusing? Could you sit down and write this entire answer right now off the top of your head? Feel that comfortable with it? It's not confusing, you got it? I will say the biggest problem in the exam is the linking between the two pieces. It's really, you've got to have a very clear discussion. But now that I've discussed CAPM, now we're going to talk about the risks that insurance covers. Is it systematic or is it unsystematic? You've got to somehow get that very clearly worded, and then you can go to the second part of the question. All right. All right, I'm going to move on, but if you want to stop me. All right, so according to the capital asset pricing model and that expense leakage, companies shouldn't buy insurance. And yet they're over 50% of the market. So they do buy insurance. Why do they? Well, there's more to risk than just the stockholders. There's other players in this market. And so that's the big one, is other stakeholders. And this part of the answer, I don't require you to have all of these. I think I asked you to pick 2 or 3 of them and discuss them. So, you know, pick some and find the ones you really like the most. But other stakeholders, that CAPM doesn't apply. So lenders. Why wouldn't John Toohey talk about CAPM in his fixed income class? Because it doesn't apply. If you think about CAPM, unsystematic risk, a huge loss at one company is offset by a huge gain at another. So in a stock portfolio, yes, one company gets really bad news, their stock drops 40%, but another company gets unexpected good news and their stock goes up 40%. Stock portfolio, that works really, really well. What about your bond portfolio? You've got a bond and the company announces something, they're going to go insolvent. What happens to that bond? It drops 80%. Another company, they announce really good news, things are going great. What happens to your bond? You keep making your 6%. There's no upside. So stocks work because there's offsetting. There's big upside and offsets that downside. On bonds, you don't have that. There's only the downside. There's no upside gain. So bondholders don't get that other side. They only get the downside. Bondholders are very worried about unsystematic risk. They don't want a bond in their portfolio to go under. So they have very skewed. Employees are a good example. Employees don't like losing their jobs because the firm didn't buy some basic insurance that caused them to go under. So they want the company eliminated, especially senior management. Senior management really wants to get rid of these risks so they don't have to worry about them. They can focus on managing the company. They don't have to worry about a fire at a warehouse and those type of things. And you might call that an agency problem, that management's managing a risk the stockholders really don't want them to manage. But that's because management doesn't have a well-diversified exposure to the company. They're fairly concentrated in that company. And so they do have to worry about those kind of things. They try to get around that by giving management more of the company's stock, but that just increases their exposure to the company even more. So they become even more worried about the the unsystematic risk of the firm. Vendors, I remember doing contracts. We'll talk about this maybe later in the class. That y'all have to take business law, I think. But the last time I checked, your business law is radically different than the one I had. I was really shocked talking to students. We'll talk about it later in this class when we talk about liability side. We had the West law book, and I don't think y'all use that anymore, do you? It's this massive thing. It weighed, well, y'all don't even have books anymore, but it's massive. I use it in my backpack, you could tell, because it weighted you down. It weighed a lot. But they covered a universal commercial code. Y'all do that? UCC? Yeah, well, I need to talk to the law profession. As a finance major, you need to know the UCC. If y'all know what the UCC is, like the risk of writing a forged check or credit card getting taken over. Y'all studied any of that? Tort, study tort, or you study agency law. What do y'all do in business law then?
Okay, same thing we have to do.
You don't have any business law at all? Well, let me give you a little secret. At UTSA, I needed a contract with a vendor, and the lawyer said, write it and send it over. I go, well, you're the lawyer, I'm not. I said, yeah, but you know the vendor, you write it and I'll put the boilerplate stuff in. I said, I've never written a contract before. Well, this will be your first time then. I was writing contracts. I don't know how to write a contract. And the lawyer took it and reviewed it, which means he didn't read it, and he stuck a bunch of boilerplate language in it. So yeah, business law is actually quite important. But what I noticed, one of the purposes of a contract is to shift risk. We'll talk about that later when we talk about some of the risks that you have, like an apartment dwelling. And you notice that language. And so some of the language UTSA required, which I thought was kind of ridiculous, but they say, hey, if we're going to do business with this company, if their employees ever come on our campus, they have to have a certain type of auto insurance. And UTSA, which is the craziest part, and the vendor has to list UTSA as a named beneficiary. Like, yeah, good luck with that. We're going to get every company to think, because their employee once a year drives on our campus, they have to name UTSA in their policy. As I thought it was overkill. But yeah, UTSA said you have to buy insurance if your employee is going to drive on our campus. It's ridiculous. But there are vendors that say, hey, we don't want the risk of your employee getting injured on our premises. We want to make sure you have the coverage. You certainly see that with real estate construction subcontractors having workers' comp, and those type of insurances is extremely important. Even if you're publicly traded, you're going to just have to do that. You can't do business because vendors don't want to deal with someone who's going to go out of business because they didn't have the correct insurance. And in regulators don't want insurers to go under. They don't care about diversification and all that kind of thing. They just don't want an insurer to go under. Have that basic form of insurance that everybody has. And these groups are going to dominate stockholders. And I think stockholders is just said it's just a cost of doing business. Yeah, theoretically, it's not doing us any good. It's just costing us money. But if we can't get these people to deal with us, we don't have a business, so we've got to get them on board. The second reason corporations buy insurance is insurance companies are actually pretty valuable. They're very good at loss control. They're better at these things than the company. They have great insights. I worked in risk management at UTSA for one week. shortest job in my entire no, actually Chick-fil-A was the shortest job in my life, but this was the second shortest job in my life. Chick-fil-A, I think, was 3 days. But I go over there and they put me in the workers' comp, and I go meet with the workers' comp insurer, and they had a stack of UTSA employees. Most of it was carpal tunnel stuff. Boy, they knew our employees backwards and forwards. They were calling them, checking in on them. What can we do to help? I thought, wow, this is really valuable. We're paying them a fee, but they're really a consulting for us. They're helping us get the employees back on the job, making sure there's nothing that's getting missed. Pretty impressive. We'll talk about boiler machine insurance. That's where the insurer can walk in and make sure you're not going to blow up something, and the cost is pretty minimal. for them to come in and make sure you're not going to injure employees. There's certain things, even if you're a stockholder, you don't want employees getting killed on the job because of, sloppiness. So, they add some value, and it's because they're experts. So it allows management not to focus on stuff they're not any good at. You turn that over to the insurance company, they'll take care of that. So it gives you a huge advantage. Also, kind of related to that is this concept of outsourcing. So workers' comp is a good example. USA had hundreds of employees out on workers' comp. And USA doesn't want to hire employees to manage all of that. And so you have these insurance companies that do that already. They're very good at it, very efficient at it. So essentially you're buying insurance, but you're also in a sense outsourcing part of that admin, which can be really valuable. It may not save you the cost of the insurance, but it will eat into a lot of that cost of the insurance. For small companies, you might not have any choice. You need insurance just to prove that you're a legitimate business. I had a consulting business, and we had to buy liability insurance. We just had no choice. It was like $3,000. I was like, I don't want to spend that. But the do consulting business, you had to say we had certain kinds of insurance, and no one's going to deal with you. You couldn't do your business. And then the last one, which is the tricky, well, not the last one, the second to last one, the IRS. So we look back at this Chubb example. If Walmart has this $500 million loss, and it causes them to lose so much money, what the IRS is going to say, well, you can take that as a tax deduction, but you can only offset it against income. So if you don't have enough prior income to offset it, then you have to offset it into the future. So it may take them several years to get the tax benefit of that loss. Chubb has many, many, many customers. And so essentially they're spreading that 500, they're essentially getting a tax deduction pretty rapidly. Essentially what the insurance company is doing is because of the tax law, they're getting to move tax benefits up many, many years, and the two companies can share with that. So the IRS does provide that. Insurance taxation might be one of the most complicated parts of the IRS code. I remember looking at USA's tax form. I mean, it's just massive. And they have to separate it between USA insurance, and then the life insurance company is completely different. Then you have everybody else, and it's quite a complicated formula. But being an insurance company, you do have advantages the way insurance companies do reserves and those kind of things. It essentially allows you to bring tax deductions forward. Walmart can't do that. Walmart gets no tax benefit until they get that loss, and they have to wait until that loss to get that charge off for taxes. And then the last one is for those businesses that are cost plus businesses. So utilities. Utilities charge their expenses plus a profit. And a utility almost wants to have more expenses. They want to have insurance costs because they get to add that into their rate base, and they get it back plus the rate. So you see how that works. That's pretty good for them. An extra $15 million, they get to add 10% on top of that. They end up making more money because they buy the insurance, and essentially their rate payers are going to cover that insurance cost. So that's the reason most companies do buy insurance. And I doubt there's a company out there that has this discussion like, you know what, why don't we just get rid of our insurance? We're a stock company. I don't think anyone has that conversation. I don't even know if a stockholder has thought about it. My guess is this is probably immaterial enough that it's not radically changing your returns. I've tried to think of another example of this, where two firms are doing business with each other and it's just essentially wasting costs, but I can't really think of another one that insurance is like. Insurance is a fairly unique business. All right. So you now know a question on the first exam. So it is an open book questions that you're going to submit on Blackboard. So you could this weekend write your answer while you're still thinking about it. Wouldn't that make sense? So rather than waiting a few weeks and you've like never seen this before in your entire life. So just, you got to be working on your paper as well, but you might get a head start on that. Of all of that, what's the most confusing of that entire thing? And don't say the entire thing. there's certainly pieces of it that make sense. Have you ever thought like this using CAPM? Have you ever let your mind wander? One thing I love about William Sharpe when he does these theories, he comes up with a theory and then he asks the question, what if the world actually worked like this? What would my theory do? So this is one of those examples. If the world actually believed CAPM, what would it look like? And he tries to find how's the world different than what my theory says it should be. And here's one place where it's different. Companies are buying insurance when his theory says they shouldn't do that. So it's a really good thought process. Really helps you get into the theory and understand it in a deep way. So if you get the question in an interview, talk about CAPM, you could bring this whole thing in and they'd just be blown away because it's a really, really good application of the theory. Okay, well, I'm going to jump on unless someone stops me. All right, the third question, let's see if you see Warren Buffett in some of this. So the third question is, so remember the first question, individuals, when should you buy insurance? Low frequency, high severity to keep that cost down. When should corporations buy insurance? Theoretically, never, but they do because of these extra stakeholders and some of the benefits from insurance. Third question, when can an insurance company, what we call write a risk, insure a risk? What are the characteristics of a loss that this industry can handle? And so we have 4 of them, but with subcategories. This first one's right out of Warren Buffett, isn't it? Ability to evaluate the risk. Isn't that one of the ones he said? Frequency and severity. Some are easy. Life insurance, we're pretty good at figuring out life expectancies at different ages, giving family history and any diagnosis. We've gotten pretty good at that. Now, some new biological agent comes along. COVID was certainly a little bit of a shock. Is there something, bubonic plague or something? But life insurance actuaries don't see that as a major issue. Actually, the one I wonder about is annuities. We have people actively out there looking for the fountain of youth who really and truly believe, they argue there is no reason for the human body to age. They consider aging to be a disease. And I thought, well, that makes sense. We just get older. But they said, no, that's not true. And the best example I thought was pretty incredible. I forget it was a blog, but I don't know if the oldest woman who's had a baby. Is it 56? Has a 60-year-old woman had a baby? So you think about that, a 60-year-old woman is creating an entirely new human body inside of herself. The human body can rejuvenate itself. It just doesn't, right? If she can produce an entire new human being all on her own, she could rejuvenate her entire body, couldn't she? I mean, and that's what these people are saying. The human body shouldn't age. It's in our DNA. Our DNA is killing us. Our DNA wants us dead because we're no longer producing babies. Go read Richard Dawkins' The Selfish Gene. The genes just want to be replicated. Once you're no longer having babies, they want you out of here. So they're just killing us because they want us dead. And so there's people out there who think they can change the DNA so we can live to be 150. What happens to annuities?
I just want to say 73 is the oldest.
73. Oh my word. What country was I in? 73. Could you imagine? I know some 73-year-old people and I can't even.
India.
Wow, wow. And the baby was healthy and
Hey, brother, 73.
wow, more power to her. Wow, that's pretty incredible. I'm gonna look that up. That's really interesting.
Oh, she gave birth to twins.
Oh, okay, well,
I just wanted to
I mean, think about it, a 73-year-old woman can create an entire new human body. If she can do that, why can't she rejuvenate her body? It's certainly chemically possible. And there's no reason why it's not chemically possible because she just did it. So annuities, that could be it. Someone discovers the way to change that. And here you are paying an annuity until the person dies, thinking you're going to die by 90 instead they live to be 150. That would wipe out the entire industry. So, there are some things out there. For generally, life insurance is pretty good with their numbers. They're pretty confident unless something radical happens. Car insurance is pretty predictable. The numbers, their loss ratios are pretty constant. I think Fort Worth had some snow this weekend. What are Texans like when they drive in the snow? Pretty pathetic. I had a brand new car in college, and my college professor required us to come to class even on a snow day. It took me several hours to get that car home that day. And there was some close calls. There were some hills where I'm just sliding back, but I didn't wreck it. But boy, I think I would have sued him if I had, because he required us to come. The whole school was shut down, but he required us to come. But yeah, but those aren't massive events. They're, it's a few $1 million that the insurance company. When speed limits are changed, that can have an issue, those kind of things. And we'll talk about that, some of that with auto insurance, but auto insurance is pretty good. Homeowners, somewhat predictable, except for these major catastrophe events that we'll talk about when we talk about catastrophes. There's some that are very specialized. They're very good at it, but they're the only ones that do it because the data is just very limited. And then some might be almost impossible, very similar to what we talk with the experience versus the exposure. Terrorism, cyber risk is a really interesting one. What's going on with cyber risk right now? My church, where I do help, I'm the treasurer, I don't do the financials. It just had a ransomware attack, lost everything. And the poor bookkeeper, she was retired in 2022. She's still working. The poor lady, she's such a good bookkeeper, but she's not an accountant. She didn't know how to create the book, so I'm having to help them with that. Very irritating. What would the insurance cover? We'll talk about that kind of thing. But it's tough. What's the issue with terrorism, cyber, flood, and earthquake? It's that we don't have a lot of data yet, and it can hit huge areas all at once. Some people are talking about autonomous vehicles. What if we have a cyber attack on the autonomous vehicles so that every autonomous vehicle wrecks all at the same time? That would be pretty scary. The entire country, someone tap in. Right now, cars aren't tied to each other. So it's hard to imagine every car in the US having braking at the same time. But if they're all tied to software and drive, self-driving by computers, then yeah, we could have a major attack. Flood, can attack huge areas. We'll talk about flood insurance. And earthquake, we're just not sure yet. We're still waiting for the big one, and it's not the big one in California. There's a major fault through Kansas. And I lived in Austin. There's Balcones fault. There's faults in areas where people aren't thinking about earthquakes. They're not building their houses for earthquakes that do have fault lines that could, the fact that it hasn't gone off in the last 200 years doesn't mean anything. It's still a fault that can move. Have any of y'all been in an earthquake before? I was in one and I didn't even notice it. I was in this building and the guy next to me, he sprints out of the building. I'm going, what's wrong with him? I just thought it was wind. And
They said the Mississippi River's a fault line too, right?
where's that?
Mississippi River.
Well, there's some in central US that people don't think about. Yeah.
Right.
But I didn't even know that. To me, it just, when I was like telling my friend, yeah, thanks, you ran out of here. You didn't care about me at all. Thanks. You didn't even tell me there was an earthquake going on. So good thing it wasn't a major one. That was in Costa Rica. They do have earthquakes quite frequently there because there's 2 volcanoes. But we're uncertain on some of these. There are people who think terrorism risk is not insurable, cyber risk is not insurable. These both make each of these make good topics for paper 2. Flood is not insurable, so the insurance industry does not cover flood anymore. It's the federal government that covers that. And then earthquake in a state like California, you're talking deductibles for homeowners insurance of like $20,000. Really high deductibles because it's just a risk the insurance industry really struggles with. I don't have hurricanes in there. The industry, I think they've gotten comfortable with the modeling. They're still a little worried about the size of some of these events. That could certainly be an issue. But we'll talk about hurricanes and floods a little bit later because insurance only covers the wind of hurricanes. It doesn't cover the water of hurricanes. And, something like Katrina, most of that damage was water, not wind. So, we have to kind of split these things up a little bit. And in Texas, how much earthquake coverage do you have in Texas? None at all, unless you buy any of y'all buying a policy for earthquakes specifically in Texas. Your insurance company will probably be a little, what do you know that we don't know? All right, so you got to be able to evaluate it. Very much what Warren Buffett said. You have to know there was a claim. So you have to know that a claim has happened. You can't have it that every time there's a claim, you all go to court to fight over it. So life insurance is pretty obvious. You have a life insurance claim. What does the life insurance company ask for? Give us a death certificate and we'll pay the claim. All right, that's pretty straightforward. This is what we call a valued policy. When someone dies, they don't say, well, let's figure out how much this life was worth. Let's see, he was 55, he was high in management, but he's probably going to retire at 60. They don't do that. They just say, tell us how much your life is worth. I think it's worth 500,000. Okay, if you die, we'll give you 500,000 bucks, or your family 500,000. It's a valued policy. Very straightforward. Death certificate. There are a few places where it's not. There's been a few cases where people just disappear. Someone goes out in the wilderness and hikes and they don't find the person. Insurance will eventually pay that life claim, but there can be some debates on that. But generally, life insurance is fairly straightforward. On most other insurance, auto insurance, home, health insurance, you have to file a claim, provide evidence of the claim, and then the battle is going to be how much are you covered for? And that's where all that's going to be. You know, it could go to court. Certainly, a lot of it. We'll talk about workers' comp and some others where things go to court. So, but generally, you negotiate. The insurance company says, "Hey, if you go to our provider, they'll replace the vendor. We'll pay them. You don't have to worry about it. We'll pay for your rental car, maybe." But you still have to file the claim. You may need a police report if you say something was stolen. That was one of my claims I had. I was lazy one night and left my bike in my car. Someone came through and smashed the window out, took my bike out. So irritating. I filed that claim. The auto insurance didn't pay anything, but the homeowners replaced my bike. Why? Because my auto insurance had a high deductible and the bike. It was a pretty interesting claim because I bought a $1,500 bike, but there was a manufacturer problem with that bike, and the manufacturer didn't have that bike, so they replaced it with a much nicer titanium bike. So they replaced my $1,500 bike with a $2,500 bike. So I'm explaining all this to USAA. They stole my $1,500 bike, but it was really a $2,500 bike. And USAA is like, we don't care. We'll just give you $2,500. Like, okay, great. But I had to have a police report. I had to file that. I had pictures of the window broken out. And they didn't want a receipt for the bike. It was I could have told them it was a $10,000 bike and they would have paid it. So I told them the truth, don't worry, but it's kind of amazing. They were like, just get me off the phone. We'll just pay you whatever you want. But you do have to have that kind of evidence to prove so the insurance company knows what to pay you. So that one wasn't Warren Buffett's, mainly because he's talking about these big reinsurance events that it's pretty obvious that something has happened. The insurance company has to be able to control themselves from essentially crime. Someone burning down their house intentionally to get the insurance, arson kind of thing. Someone wrecking their car. It was humorous a few years ago. One of the car dealerships was showing people driving their cars off the side of cliffs because they wanted to get the insurance so they could buy a new car. And the Insurance Institute of Texas, or whatever that trade association, they actually got them to stop showing that commercial because they said that's a felony. You're encouraging your customers to commit felony in order to buy a new car. So please take that commercial down. You can't do that. You can't intentionally wreck your car just so you can get the insurance claim. So it has to be fortuitous and accidental.
So you say that so for instance, you're talking about your biking for the truth of the amount.
Right.
What would happen if you had lied and said, oh, instead of my bike being a $500 bike, it's $1,000 or $2,000? How can they properly say?
Well, my amount I got from the person who sold me the bike, and they looked it up. If it was obvious, he said 2,500, I tell the insurance company 5,000. Yeah, you're talking criminal activity.
Right.
So it's very dangerous to do it. You can go to jail. There's a lot of people who go to jail because of insurance fraud. If and there was one case at USAA, a guy said his house got robbed. So the adjuster went to his house. He wasn't home, but they had his mom's address. So they went to the mom's house and say, "Hey, we're just wondering where your son is." They said, "Oh, he's not here, but all his stuff's in the backyard." They go, "Oh, all the stuff that got stolen is in the backyard," and he goes to jail. I mean, that's illegal. You can't do. I mean, it's pure. He forgot to tell his mom he was committing insurance fraud, and so she just said, "Yeah, it's right in the backyard." So yeah, what was it? You were talking about the arson case. I mean, arson's illegal, obviously, for insurance fraud, but there was one case where the guy burns his house down to get the insurance. And the policy clearly says if the insured causes the loss, it's not covered, but the wife didn't know he was burning the house down and she wasn't insured. So she said, "You pay me, you don't have to pay him, but I'm insured. I didn't cause the loss." But that's the kind of thing insurance companies are up against. And there's a few areas where this is important, and it depends whether it's auto insurance, homeowners, or life. They're a little different. So the first one is moral hazard. Moral hazard is illegal. Moral hazard is when you intentionally cause a loss to collect the insurance. That's the arsonist kind of thing. That one is illegal.
That seems like it's pretty common, right?
Oh, I don't know the numbers.
Well, like, cause you hear a fire in the building, oh, they just want the insurance, cause that's happened, I've seen it happen.
Well, they're definitely going to have investigators go and look and see if it's
Right,
it's
so I've
caused.
seen two cases of that, yeah, I mean, they just assume, hey, they just probably want the insurance, or it's talked about. I think that's, like, that kind of happens quite a bit, you know.
I don't know frequency. I know there's a famous, in fact, Law and Order actually did this. You know how Law and Order does a real life
Right.
thing, that some of these fire investigators were actually assessing things as being caused on purpose when they actually weren't. I don't know if you've ever seen that Law and Order one, but there's a pretty famous case where their traditional way of looking at things said, "Oh, that's arson," and they discovered this one guy was going to jail for killing his family, and they finally discovered it was an accidental fire. He shouldn't have gone to jail. It was a pretty interesting case. So I mean, there's some subjectivity here, and it's going to be up to the jury to decide, if they really know you did it or not.
Right.
But yeah, it is illegal. You don't want to file. I remember watching Married with Children, and Al Bundy. Y'all don't know Married Children. It's before your time,
Oh, yeah.
but Al Bundy's going to talk about the Rembrandt that got stolen from his house. Well, he's probably not going to get away with that. They're going to kind of go talk to Peggy and know that they don't own a Rembrandt. All right, the next one is morale hazard. So you add the E to it at the end of it. Morale hazard is buying insurance changes your behavior. So the very act of buying insurance makes you a more dangerous person. The easiest way to think about this is auto insurance. You go buy your Ferrari, $250,000 car. You go pick it up. You get into it and go, "Oh, I forgot to call my insurance company." Now you got to drive the car home. How do you drive home that night? 12 miles an hour. You see another car, you get off, you park, you wait, you park it in your garage, you sleep in the car, in the garage with a rifle. Next morning, you buy the insurance. Are you a more dangerous driver after that? Yeah, you're a much more dangerous driver. So having insurance makes us more dangerous. Now, if that's true for everything, for auto insurance, definitely. Insurance companies charge you more for auto insurance because you bought auto insurance. I mean, it seems unfair, doesn't it? But they know the fact that you buy auto insurance is going to make you a more dangerous driver. Health insurance, I doubt it, because you have a lot more skin in the game. Breaking a leg is much more skin in the game than losing a car. But maybe. Are there people who say, I don't have any health insurance, but as soon as I get it, I'll go bungee jumping with you? Have you ever had that conversation? Seems a little extreme to me. Life insurance, absolutely, pretty unlikely there. Homeowners, I doubt it. I mean, I guess it's possible. There's a home where I ride my bike that I'm going to tell y'all, so when I die, y'all can sue, have my family sue this. But they had this little puppy dog, unleashed. I'm coming down the hill 40 miles an hour. The dog runs right to my bike. I almost killed him once, almost killed me. And that's just ridiculous. Do you think they were thinking, we have homeowners insurance, we can get a dog and not have them leased up because we'll be covered for that? they're gonna, I yell at their house every time I go by because it's just so dangerous. But I doubt that homeowners, I think really homeowners, people just buy because they know they need it. They don't really think about, you know, what can you do that's really more dangerous? The most dangerous thing homeowners do is have a dog. The dog is the biggest liability issue you have. And I can't imagine someone saying, we'll get a dog as soon as we get homeowners insurance. That just seems like a strange conversation. I think auto insurance is the most obvious one, and it definitely is affecting you. All right, I don't want to get in adverse. So we'll start here on adverse selection. It has to do more with life insurance and homeowners. We'll start here next time. So get your paper one really far ahead, and you might start drafting out this question on the exams. So you get ahead of the game.